Hello there everyone, today's video is all about capital gains tax and specifically where entrepreneurs relief can be denied. Now entrepreneurs relief, or to give it its new correct name, business asset disposal relief, is basically a favourable capital gains tax rate where you only pay 10% capital gains tax instead of the normal default capital gains tax rate, which is double, which is 20%. So you're selling something valuable like shares in your own limited company in a business, could be selling for a few million. That's a big difference between paying 10% and 20% tax. So this video I want to tell you about is all about a case that went through the courts recently which challenged conventional thinking around this, the way that we've always thought about how these rules worked, because it wasn't always cut and dry, even though we thought it might be. What do I mean? Well, let me explain. Let me get into the detail here. So, company. Trading company making widgets, has a bit of surplus cash after many years of successful trading, and invests the cash on the balance sheet. Could be in all sorts, could be in property. Well, in this particular court case, it was property, but just assume hypothetical now. It can be in any kind of investments. So basically, the investments are nothing to do with the trade. So we're not talking about having the building from which the business trades out of, just assets held on the balance sheet of the trading company, nothing to do with the trade, just held for investment purposes. Better than having it cash in the bank account, invest in some property or whatever. So that potentially is a problem when you come to sell shares in the company. Why? Because this entrepreneurs relief, this business asset disposal relief, only applies to disposal of shares of trading companies that do not have a substantial element of non-trading activities going on. All right? So basically the company has to be a trading company with a bit of investment on the side, for want of a technical phrase. And if it's shown that the investment activities or the non-trading activities are not substantial, or not significant, then you get your favourable 10% tax treatment when you sell the shares in the whole company. So in this particular court case, what was challenged was that bit about, is the non-trading activities substantial? Is it too much? Is the amount of the investment activity within the trading company too much for it to then negate getting 10% capital gains tax instead of 20%? And the courts ruled that it was. So what is the rules? What does the law say? Well, the law doesn't actually give us any specific numerical figure. It just says the favourable rate of entrepreneurs relief, business asset disposal relief, will apply to businesses that are trading with not substantial amounts of non-trading activity. Okay? But HMRC, thankfully, in their guidance, their manuals, they explained that they deem this to be 20%. 20% of turnover, assets and time spent. So basically, if you look at these three things, and it's just the guidance. So you consider these and you say, look, the income of my company that derives from investment activities, investment properties, is it more than 20% of the turnover of the whole business? Then we have a look at the balance sheet. The assets on the balance sheet, is the value of the investment assets more than 20% of the total assets on the balance sheet? And thirdly, we look at time spent by management. Do management time spend, does the senior management spend more than 20% of their time managing these investments over running the day-to-day trade of the company? And this has been on the guidance books for years, but crucially, this is not law. The law just talks about significant amount of non-trading. So HMRC have put guidance in, and people have relied on this guidance for years, but it's only recently been tested in the courts in this case. So I would suspect what's happened, well, in fact, I know what's happened, that the director shareholder of the company who was denied the entrepreneurs relief, in this case, they had investment properties, he said, look, time spent. I'm not spending anywhere near 20% of my time looking after the investments on the balance sheet. Might have exceeded the assets if he's got the investment properties, but it's not. You don't have to hit all three. It's just guidance. You've got to consider all three, not meet all three. So he argued. He said, "Look, I spend nowhere near 20% of my time looking after these investments. These are passive investments. So because I spend maybe 5% of my time looking after these investments, I think I should have entrepreneurs relief because HMRC, you've said 20%. That's the cutoff, and I have way less than 20%." Went to court, went up to the upper tribunal, first tier tribunal, upper tribunal, and basically the upper tribunal, the taxpayer lost, and so HMRC were then forced to change their guidance. So HMRC actually changed their guidance because, remember, this guidance does not have the force of law. It's an interpretation of the law, which we've all followed for years. Now that it's finally been tested in the courts, upper tribunal sets a precedent in law. So that's the precedent, the court case on this, not this guidance. So HMRC has now changed their guidance. So basically what the court said, they said, look, you can't just go on this numeric 20% thing for these three things. Boom, boom, boom. Can't do it. You've got to take a holistic view in the round. And every case is different. You've got to say, is the activities of this company, is the non-trading activity substantial compared to everything else? You cannot just be prescriptive on this. Okay? I think basically what they were saying is that it was all to do with this one here, the time spent. Because, like I said, this guy said that it was all passive investment. When they looked at this, they said actually it wasn't, and he was spending quite a bit of time managing the investments, basically. So therefore, they said, look, this has got to change. You can't just rely on this 20% thing, this 20% rule, which we've all relied on. Taxpayers, accountants, HMRC, it's in their manuals for years. But no longer can you rely on 20% for all of these three things. So, however, just, when you think about the commentary and you read about the notes and everything, the analysis that followed this case, if going forward, the turnover and the assets, if indeed they are still less than 20%, then I would suspect you don't even need to go beyond that and look at the time spent analysis in terms of looking at the holistic approach, everything in the whole. So I would say, going forward, if the turnover from the investments and the assets on the balance sheet relating to the investments are less than 20% of everything, then you haven't got a problem. It's only if you bust 20% on turnover and assets and you think you're going to be below time spent that you could have a problem, and you've got to think again. So even though this 20% thing has been revised, I would suggest, looking at the commentary on this, that if you meet the turnover and the asset size is below 20%, you shouldn't have a problem. It's because of this time spent. It's almost like a get out of jail card. It's almost like a let out to say, well, look at the assets. We've got a bit of plant and machinery in our widget making business. We've got some computers, but we've got a £5 million investment property. That's going to bust it straight away. And the turnover could be significant. So, that's why HMRC, when they went up to the courts, this thing was looked at again. They said, actually, no, this is not right, holistic in the round. But as a rule of thumb, when you start to do this analysis, will this qualify for entrepreneurs relief? Start off with the turnover. Probably start off with the assets. That's the easiest one. What's on the balance sheet? What's the size of these? And if both the assets and the turnover are less than 20%, I would say you probably don't have a problem. It's only if those two are more than 20%. Then you got to say, well, is it genuinely a passive trade? And then you've got to argue on the grounds that this guy did, which is now an uphill battle. Whereas in the past, it was fairly straightforward to say, hey, I'm not spending 20% of my management time running the investments. It's all running the widget business. So, food for thought, interesting one. And it's like I said, it's quite fascinating from a tax advisor's point of view to see these things tested where we've relied on HMRC's guidance because the law doesn't give us much to go by. And then for years we think this is how it is, and then it's tested in the courts, and the courts say, no, that's not how it is. And then we're back to a new interpretation of what the law actually says. So the law, remember, just talks about a non-trading activities in the business. You know, it has to be no more than insubstantial amounts. So it's quite waffly what the law says, hence the reason for the interpretation in the first place. But basically this gives us something to think about now. So if you are in this position where you are the director shareholder of your own company, you've been trading for many years, you're thinking of selling, you're hopeful that you're going to get 10% business asset disposal relief, capital gains tax at the back end when you sell, and not double the tax rate, 20%. Look at your investments. What is the company invested in? Instead of pulling out surplus cash as dividends over the years, you've chosen to invest it on your balance sheet in goodness knows whatever, property, crypto, who knows what. But just have a look at that. Have a look at that. Think about this court case. Can you say that that investment element of the business is insubstantial compared to the overall trade? Can you say that? Because if you can't, you'll pay double the capital gains tax. So, interesting topic there. So if you like this video, please do remember to subscribe, and I will see you soon.